This is a bullish and bearish order block. If we take a look at a chart, you can go ahead and mark out the order blocks that you see, and then I will mark them out on my chart. So I'm going to mark out some bullish and bearish order blocks in a second. So if you look over here, this is a bullish order block. We have a down close candle followed by price heading higher, creating a bullish fair value gap. So this entire down close candle right in here is a bullish order block. So if you mark out the opening price of that order block, that's generally a sensitive point. You can see that price taps it perfectly right there and then expands away from it. So since the draw on liquidity was lower, it only takes out this little small short-term high in here before dropping lower. But this is an example of a bullish order block. If we look up here, here's an example of a bearish order block. So notice how there is two up close candles in a row. I'm not going to mark out the upper up close candle. I'm going to mark out the opening price of the consecutive up close candles. So notice we have an up close candle here, an up close candle here. So we have two in a row. When price breaks lower and creates this bearish fair value gap, that validates this as a bearish order block. These two consecutive up close candles. When price returns back to the opening price of the consecutive, that's going to be a sensitive point for the algorithm to refer back to and then expand away from if the draw on liquidity is lower. So it taps it and then drops lower. Right in here, we do have another order block. So see how there's just one up close candle and then it dropped lower, creating a bearish fair value gap right here. This makes this a order block since it created a fair value gap after breaking through that up close candle. So when price returns back to that opening price, this is going to be a sensitive point and then price will likely drop lower. This is technically a propulsion block because it's an order block that retests an order block, but it's still an order block, so we're just going to be referring to it as that. When price creates another two up close candles in here, it drops lower, creating a bearish fair value gap. When price returns to these consecutive up close candles, again, the entire thing is the bearish order block. Both of these up close candles is a bearish order block, but the opening price of these up close candles is going to be a sensitive point of the order block. So bearish institutional order flow is just when up close candles are being respected, just like we have here. Price drops lower again, returns back up. Where does the algorithm refer back to? It refers back to this up close candle. So again, we have another up close candle in here, okay, followed by a fair value gap. So once we have that, it makes it a valid order block. Notice in this example, it doesn't reach up into that opening price. Remember, the entire up close candle is the order block here. It still does tap it. It just means it's extremely weak because it's not willing to return back up to there. It just wants to tap into that lower wick and then expand lower. So in instances like this, where you do see a large lower wick, what you can do is you can mark out both the lower wick and the opening price. Okay, price will refer back to that lower wick if it's pretty big. You could also mark out the mean threshold. You don't need to mark out all these things. Typically, I'll just note on my chart where the order blocks are, where the fair value gaps are, and I don't leave them on my chart. So in this example, notice it taps into the lower wick to that open around that area. Then it starts to expand much lower for the sell side liquidity lower. So those were some examples of bearish order blocks. In here, we do have an example of a bullish order block. So really, I'm just looking for a down close candle or series of down close candles followed by a gap or a fair value gap. In this example, we do have 4 down close candles in a row. So I'll mark out the opening price of the 4 consecutive down close candles, and I'm going to extend that out in time, meaning I'm going to drag that out. Notice how it created these down close candles followed by this fair value gap right in here. That makes this a valid bullish order block. I'm going to utilize how in the model we're mainly using these order blocks to find draw on liquidity targets. That is for a later lesson though. So again, we're utilizing the opening price of the consecutive down close candles. We have 4 in a row. I'm not going to be marking out this one. Price breaks higher, closes above the order block, creates a fair value gap, returns back to the opening price of the order block. That's a sensitive point, and expands away from that. So that's a sensitive point. So when price trades higher here, bounces off that order block, the draw on liquidity is for price to take out this high. When price returns back lower in here, we do have a small little order block in here. So it's not always going to be a down close or a series of down close candles. Sometimes it's just one. Why is it just one? Because there's only one down close candle here. If there was 2, I'd mark out the opening price of 2. In here, we do have a down close candle followed by this small little fair value gap right here. So sometimes it's not super easy to see. It's super important to go back and back test. Really study these. You have to back test in order to train your eye to see it. Repetition makes mastery with these concepts or with anything. So since we have that fair value gap, price breaks above it, I can mark out the opening price. Notice how price is sensitive to that opening price of the order block. We can mark out mean threshold, which is where price really came down to. It dug lower, but it didn't take out the low of the order block. If price were to take out the low of it, then it kind of invalidated that idea of this being a bullish order block. So we'll go over stop placement in later lessons. Price returns back lower. ICT talks about wicks do the damage, bodies tell the story. So wicks, they did damage here. They took out some of the stops right in here, but it didn't take out that low, the order block. Wicks do the damage, bodies tell the story. How do the bodies tell the story? Well, it's showing that bodies are not willing to go beneath this opening price and beneath this fair value gap. And it did that twice. So this is a sign to me that likely the algorithm has not left the buy program and it's going to continue to seek buy stops. So where are buy stops at? Above this high and then above this high as well, and also above this high. So that's going to move us on to the last part of this lesson, which is sell side liquidity and buy side liquidity, or sell stops and buy stops. Sell side liquidity is below old lows. Buy side liquidity is above old highs. So smart money likes to target these old lows and engineer these old lows so retail traders put their stop losses beneath them. Then they like to target it before taking price to a level where they can exit that long position that they got in. Now you might say, well, damn, what's the purpose of this? Why? There's no way there's this huge thing going on behind the scenes where they're just engineering these old lows, targeting them. Well, the purpose of this is smart money trades with a whole lot more money than we do. They're trading with billions of dollars. And in order for smart money to get in order for any of us to get in, there needs to be a counterparty to our transaction. So for every buyer, there must be a seller. For every seller, there must be a buyer. Let's say, for example, we're just going to use extremely basic numbers right here. Let's say that smart money wants to buy $10 worth of the S&P 500 right here. This is just for example purposes. So they want to buy $10 worth of the S&P. But let's say retail collectively is only willing to sell $5 at that level. Well, they need to do something on the chart which is going to entice retail to sell more. Okay, so when price starts to take out these old lows in here, well, breakout traders, well, now they could start to sell more, right? And now any retail traders, so let's say they were trying to buy the $10 worth of the S&P 500 in here, but retail was only willing to sell $5. Well, from what they have taught us in the books, right, when price breaks beneath an old low right in here, there's breakout traders. So when price breaks an old low, retail is looking to go short and target lower levels. When price also breaks through an old low, any retail traders that were looking to long this potential retracement in here and then target the high, their stop loss beneath this old low is categorized as a sell stop or sell side liquidity. So when price takes that out, their sell order becomes a sell market order when price takes out this low right here. So there's sellers getting pushed into the market when price takes out this old low by the breakout traders and by the sell stops. So that may add more liquidity for the counterparty of smart money's transactions. So if they can only get $5 collectively of retail selling up here, when price takes out this old low down here, it's engineering more sellers into the marketplace. So that's what the algorithm is coded to do every single day. It's coded to create old lows, then run them if the bias is bullish, and then expand higher because it's inducing retail short and it's taking out retail sell stops. So there's going to be sellers always, all the time, below old lows. That gives smart money more liquidity and a counterparty to their transaction, right? So price is going to take out those old lows if the bias is bullish, then target buy side liquidity above old highs. So it's always moving from sell stops to buy stops or buy stops to sell stops. In a bullish example, right over here, above old highs, we have buy side liquidity. So if the bias is bullish, right, price will take out old lows, which is sell side liquidity, and it'll target buy side liquidity. So when you're anticipating for higher prices, price is only going beneath old lows for smart money to buy from sellers and then target higher prices. So if smart money buys at a discount down here, they also need to target old highs. Why? Because there's buyers above old highs. There's buy stops. So anyone that trades breakout stuff taught in retail books, they're buying above an old high. Well, that is a buy order for smart money to sell to. Also, any retail trader that goes short in here when price retraces back up, we're all taught in books to have our stops above old highs. So there's going to be buyers in those two aspects above this old high. Smart money leaves behind old highs to then target later on to have exit liquidity. So essentially, the market is always going to target old lows and it's always going to target old highs. So that's the basics of buy side and sell side liquidity, and that's how it is used for smart money to have a counterparty to their transaction. And they really do engineer these old lows to create liquidity. They use the retail patterns that they brainwashed everyone with to create a counterparty to their transaction. And they're doing this every single day. So if we were to look at a chart in here, here's an example of buy side liquidity. You're really just finding an old high. If you want to find more significant liquidity, look at a high where price created a high. It moved away from that high for a little while, and then it returned back to it. Okay, that's going to be more significant because it allowed time for retail traders to accumulate short positions and put stops above the high. And then also when price breaks above this high, breakout traders are also buying. So they have people to sell to. They have buyers to sell to above the highs. Price takes out that old high and then targets the sell side liquidity down here, because there's going to be sellers beneath this old low. Smart money can buy back from them if they want to, or they could target lower liquidity. Below old lows is sell side liquidity. So each of these old lows in here, this can be a target when the drawn liquidity is lower. The algorithm is going to target old lows because there's sellers beneath there. If they want to buy back their short position, they need someone to sell it to them. When price takes out these old lows, breakout traders are shorting. Also, people that got long in here, lots of stops are going to rest beneath these old lows. So they really manipulate retail traders with the logic that they were taught in books and that we're taught in books. I'm a retail trader as well, and use it against them. And I know it's hard to believe, but when you see the execution videos that ICT does and that I post, and you see how these concepts can actually work real time, your eyes will be opened to the manipulation that occurs in these markets every single day. That's going to be it for this lesson. Hopefully you guys enjoyed, and stay tuned for episode 2 tomorrow. Catch you later.